Welcome everyone to the Kindle Report, where I share my 44 years of experience, help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Well, this is the week of the Fed, folks. We're going to focus on the Fed, what I believe their intentions are, and what's likely to go on throughout this week. I think it's going to be another pump. Let's get into tonight's video. The Fed has been very consistent on what they've been telling us for the better part of 2 years now. And what I've been telling you for a while is what we've been seeing in interest rates is a normalization of the rates. And I believe that is still what's going on. Everyone that has been around the markets for the last 20 years actually thinks the way that the Fed will work with the markets is that they will determine and raise and lower rates accordingly. And I've been telling you for some time now that game is over. They don't want to end that game. Powell made it clear last year sometime, but he made it clear that they're not in that business anymore. I feel like I'm the only one that picked up on that line. Meanwhile, everybody's talking about what they need to lower rates and do all these things to make the economy come back. And the economy doesn't need to come back. It is back. If you look at the metrics, things are working just fine at these current interest rate levels. And what I believe is going to happen is you'll see the markets adjust the rates primarily on the back end of the curve. I don't see any reason for them to change the front end of the curve right now. It's not really affecting the economy. There might be some slight effects going on, but we're seeing the 10-year and let's say 10-year plus, we're seeing these rates start to bounce around a little bit. We came down to around 4.28, bounced back into the 4.4 plus, almost back to 4.5. So the back end of the curve is where the action is going to be going forward. And I don't see that changing much. I'll talk about that in the Substack newsletter that I'll release later tonight. But just know that what the Fed is actually doing is letting rates normalize, and they have normalized. I actually believe that we could see the 10-year coming as we look out as high as 5.5. Ultimately, we could see mortgage rates even tick up more, primarily to something that I believe is going to happen, especially as we come in to 25 and beyond. In 2025, we're going to see a lot of demand come in, primarily from the multifamily and some of the commercial folks that need to refinance their debt. And that's going to be a big part of what's going on. So demand on mortgage money, on lending, is going to stay very high as we go forward. So there's not going to be any choices to start to lower rates to make that happen. I believe a couple of things will happen, especially in multifamily and some of these other areas in commercial, as there's going to have to be, all the cap rates are going to adjust. How you make money, the margins are going to go down. The old days of these low rates and these massive margins and being able to roll properties every 2 to 3 years into a higher value isn't going to happen anymore. There's going to be some new paradigm that will continue to unfold as we go forward. I know there's been a crazy amount of talk that CRE was going to crush the markets. Well, we're talking about a year and a half later, still hasn't happened. And if you look at what's going on in some of those areas, we're definitely seeing some changes in the markets. If you look at what's going on in the financing side of these bigger properties, they're just going to extend. It's called pretend and extend, and they'll keep these rates just going where they are. They'll swap out different types of properties. They'll be trading properties, all kinds of things to reconfigure the marketplace as far as real estate goes. But yields are not coming down. It's not just higher for longer. That's not the game. The game is just let it normalize where rates should be. And where I'm saying the rates should be is where the markets think they should be, not where the Fed thinks they're going to be. The Fed's not going to panic. So what we're going to likely hear is no change from the Fed at all. They are going to play up that we have CPI coming out on Tuesday. Thursday, we have PPI. Those numbers are going to come in probably as expected. We're looking at 0.1 up month over month, and I think 0.3 year over year. So they're going to be expanding a little bit, but it will be within the market's expectations of what is likely to happen. I believe what we'll hear from Powell on Wednesday is he's going to be a bit, I wouldn't call it dovish, but he's going to be very accommodative in that they feel like they're seeing numbers from inflation that is going to be positive. Now, folks, just know they already know those numbers. It's not like they calculate the PPI and the CPI 5 minutes before they're released. Everybody knows these numbers. And so when they're in the FOMC meeting on Tuesday and coming into Wednesday where they're going to write their statement, they already know all these facts. There's no surprises here. So don't think there's some sort of surprise. But let's talk just a bit more, because I think they will mention that maybe they're going to curtail some of the QT. That's where I've been focusing in the last several meetings. We finally got that. I will try to bring up some charts here in a minute that shows how the balance sheet was being reduced even further back than you think. This has been going on for a while, but it's not seeing any change in the trajectory, even though they're saying they're slowing it down. Primarily on the mortgage backs, those things are still burning off at a pretty good rate. And so we're going to see that balance sheet continue to decline. Well, I think we get down around $6.5 trillion when it's all over. I think we're around 7.2. But overall, there's not going to be any surprises. It looks like we still have upward momentum building. The WaveTech database continues to be quite positive from the standpoint of intermediate levels, so nothing's changed there. And I'll just say, if you don't get the Substack, get that. It's $8 a month. There's a free trial for, I think, 1 week free trial. And just sign up. That's where I do all the micro analysis. So I'll go through step by step. I show you what the metrics are on the database and get into that a little more in depth. But this is going to be a high level expectation for this week of June 10th, and mainly about the Fed. And I don't see any surprises coming out on any of these economic metrics that we're seeing. Quick back step just for a minute to the unemployment numbers that came out last week. I mentioned that I thought it was going to uptick. We did uptick from 3.9 to 4.0. The jobs numbers were better than expected, but we're seeing gradually some of the things starting to happen that I've been talking about. And I think we ultimately get up to about 4.2, as high as 4.6. And this will continue to go on, I believe, into Q3 and 4 is where most of this activity is going to happen. And I think that's going to make the Fed really happy about their efforts, because these aren't big numbers. If we go up by 1%, we get into 4.2, 4.6 is not going to be a really big number. We'll find out at sometime in November if we're going to have a new administration and what's going to be going on in this country and therefore on the planet. But the bottom line is that it looks like we will see a continuing increase in the unemployment level. We should pay very close attention to the words, as always, when Powell comes out. And I think he is going to tell us a little bit about inflation is starting to come under control. So this is the core CPI, and I've been talking about for some time that I think the CPI is actually going to start to climb, and I believe that's the case. We're probably going to come back to around 3.5, so I do see increases, whether it's this particular month, but I think as we go through the summer, we're going to see some increases on the CPI and some of these other numbers. Let's take a look at the money supply. And I talked about this in a video I did last week. And this is interesting to watch because it looks like M2 is going to start to increase. Let's take a look at the velocity of the money, and we're seeing where it's being projected that it's going to cap out. So this is going to be interesting because this is what's kept inflation somewhat under control. So if velocity and the turnover money starts to slow up, then we're likely to start to see some changes here from the standpoint of expectations of inflation. So I've been preaching for a while that I think CPI and PPI will start to climb a bit. Almost, I've been calling it a echo bounce in inflation, and I think that is important to understand because this is what's going to drive the Fed. Not in this meeting, but there's a July and a September meeting. I think this will be coming into focus, and market participants will start to also focus on this. But more importantly, this is what will drive that back into the curve that I was talking about a little while ago. So this is going to complete tonight's video. I just wanted to give you an overview of expectations for this week. Make sure you get the Substack newsletter so that you'll get the day-to-day microanalysis and stay fully up to date. Thanks again for watching, and we'll see you on the next video.